Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand, evidence-based holistic insights to help you master the game of building wealth. And just a little call out, if you spend any time on YouTube, there's a link in the show notes. I've been posting a few videos on YouTube, so if you're interested in those, maybe check them out. Okay, let's get in today's episode. And I found it a really interesting blog to write, and it's a topic that I've been thinking about quite often, and it's a topic that we get asked about quite regularly as well. So if you had an unlimited financial budget and you ask me what is the best property investment option, I would say to you, go and buy an investment grade house. So a house in a blue chip location that has heavy land value, in a location where there's excessive demand but limited supply, with a property that has some sort of uniqueness with it, either because it's in the best street within that suburb, or because of its architectural style, or because it has an alternate use in terms of, you could redevelop that property or build a family home on that property that isn't already there that is common in those streets, but not for that property yet. Something like that, right? So that would be the sort of, if I painted a picture, that's what I would buy. Now, in most capital cities, you're certainly going to need a seven-figure sum. It's north of $1 million. And in some capital cities, it might be closer to $2 million. And of course, not everyone's budget extends that far. So the question then becomes, if I can't afford an investment grade house in a blue chip location, what do I buy? Do I buy an apartment in a blue chip location? Or do I move further out into a secondary suburb, or maybe even further out beyond that, depending on my budget, and buy a house? Do I never compromise and buy a house? Or is it okay to buy an apartment at some time? And that's the episode today. That's what I'd like to talk about. Now, in the houses versus apartment debate, let's start with the obvious one, which is underlying land value. Most people think houses are superior because they have a direct underlying land value and you have full control over that land. And of course, that is true. They do and typically have more land value, again, depending on the house and the location, and to some extent, depending on the planning conditions, you might have full control over that. But it's also true that older style apartments have an attributable land value component as well. And that's true for two reasons. Firstly, from an older style apartment perspective, the dwelling's probably depreciated as much as it probably will. The interior finishes aren't necessarily as great as those or as nice as those as new build apartments. And as I said, the dwelling has been around for a long time. So, it's sort of depreciated. It's lost all the shiny new sort of appeal. Having said that, those older style apartments are constructed to a much higher standard than the new builds today. The second reason is that those older style apartments tend to be on pretty large blocks, maybe 800 square meters or something like that. But there might only be 4, 6, 8 apartments on that block. Whereas today, if a developer redeveloped that land, they'd probably put, as many as they possibly can, probably 15, 20 apartments on that block. And so these apartments do sit on some very valuable parcel of land. And so if you've got 4 apartments on this very valuable, 800 square meters of land, then each, and they're the same size apartments with the same amenity and so forth, then you could argue that your share of the land is, 1/4 of that land, so 200 square meters if you like. But the point is that the attributes or the characteristics of that apartment asset is very land heavy. More than 50% of its overall value is in land. And because apartments are intrinsically undervalued, it's not uncommon to see that proportion be much higher than 50% in the current market. Now, of course, not all land is created equal. You might have 1,000 square meters of land in the middle of nowhere versus 150 square meters in a blue chip suburb. I would much prefer the 150 square meters in a blue chip suburb. Quality trumps quantity every day of the week. So land value component is important, but the quality is most important. And so what we want to do is get the highest quality land and the most of it. And that will really represent probably the best investment we can make. Now, the next factor you want to talk about is really maintenance and control. Property investors, I think, are attracted to property because we can control the asset, whereas we have no control over stocks, of course, and the management of companies and the decisions made in those companies that might impact shareholders. But we have full control, subject to law, of course, and rules and restrictions over property assets. Now, it's true that houses typically afford you more control than apartments because apartments are managed by the owners corporation, and you might have many owners in that owners corporation, and it can be like herding cats in terms of getting decisions made. So the more owners you have probably the more difficult it's going to be. Of course, you want to check that out before you invest in a block. You want to make sure that the owner's corporation is well functioning, that they're quite proactive, that they're spending money on regular maintenance and providing for those things. So hopefully it's not a surprise to you. And if you do buy into a block where it is functioning very well, maybe it's not such a big deal, but it's true that, of course, you've got greater control over a single dwelling property, a house, as opposed to something that's managed by an owner's corporation. Maintenance costs can vary. Again, doesn't necessarily mean houses will always cost more than apartments. They tend to, just because the dwelling size tends to be larger, but also apartments can cost money, and depending on the age of the building, things like replacing window frames, doing those sorts of things, painting, they can add up in terms of costs. So, maintenance cost needs to be considered as well. Now, in the old apartment versus house debate, we can't necessarily ignore the middle ground, which could be like a villa unit. A villa unit's generally a single level dwelling that's often detached, so standalone. It might be on a large block. There might be some common property, such as a shared driveway, and there might be 3 or 4 other units on that block that kind of share that block of land, or it might be 2 blocks of land put together. And they tend to cost more than apartments, of course, because they do have their own sort of separate land component. And they can make for great quality investments. Of course, if there's because there's fewer co-owners. So if you're one of 3 villa units, for example, potentially you could get together with the other owners and sell to a developer one day, and having that greater level of control just because there's fewer other owners can be attractive. But also villa units, you've got to be careful because, there's a lot that are constructed and exist on, busy main roads often. And sometimes you've got to be careful where, privacy is compromised, particularly in security, particularly maybe if you're the front of the block. So you want to be careful that they can make for really good quality investments at a budget that might fall somewhere between an apartment, a 2-bedroom apartment, and a small 2-bedroom house. But you've got to be very selective in terms of villa units. Now, whether you buy an apartment or house, or whether you target an apartment or a house, I think really mostly comes down to your budget. For instance, if you've got a budget of $500,000, I think you're going to be making some compromises to get a house. That is, you're probably going to end up either in a regional location or a semi-regional location, or substantially further out from the CBD that's going to have less scarcity, more land supply, etc., etc. In that situation, I think you'd be better off buying into the apartment market, and I'm going to talk about where it is in the cycle in a second. But if you've got a budget of, I think less than 700 to 800, I would probably lean towards an apartment. Something more than 800 starts to push you in the villa unit space, I think. So that way you don't need to necessarily compromise on the quality in terms of location, but hopefully you can get some more land value. Now, as I've spoken about previously a few weeks ago, in fact, it's more important these days for property investors to consider where property is in the cycle. That is geographical markets and property types. And in March, and there's a link on the blog and the website to this, but I wrote a 2-part series on investment grade apartments and where they are in the cycle. And we know that from observing history that property tends to move in 2 cycles, being a flat cycle followed by a growth cycle. A flat cycle, typically you get very little growth, maybe growth at inflation, but nothing substantial. And that cycle might last for 5 to 10 years, typically. It can last longer. Perth's recent flat cycle lasted 15 years, but probably tends, or at least since 1980, hasn't lasted longer than that. And then a growth cycle occurs when you get above average growth, often double digit growth, north of 10%. And a growth cycle tends to last between 5 to 10 years as well. And the answer is you've got to hold the property to enjoy just as many growth cycles as you do flat cycles. So you don't want to buy just before a flat cycle, because it means that you're probably going to have to hang on to the property for 20 years before you see any returns that you are mildly pleased with. Whereas if you can buy just before a growth cycle, of course, you get that additional kick. So I think it's when thinking about house versus an apartment, I think we need to think about where are houses in the cycle, where are apartments in the cycle in the geographical markets we're considering. And if we've got an open slate, like we don't necessarily need to buy in a particular state, then we can think about, where houses and apartment markets are nationally, and which of those markets represent the best opportunity in your price point. The other factor to think about is the area's propensity to continue to grow. Because really what you want to do is invest in a property today, hopefully hold it for the next 30 years and enjoy substantial growth. Hopefully something around 7%, which means that if you buy something for $500,000, for instance, it's going to double 3 times over the next 30 years. So what is that? $4 million. So that's substantial increase in value over that time. So what you want then is the highest return over the next 30 years. To be able to achieve that, you need to invest in an area where the buyers can always pay more. Now, I wrote a blog back in April that talked about, looked at the last 20 years compared to the previous 20 years in terms of growth. And the last 20 years has grown at half the rate of the previous 20 years. And what I concluded is that borrowing capacity probably contributed substantially to that first 20-year period, which is between 83 and 03. And borrowing capacity is actually reduced over the second 20-year period between 03 and 23. And so therefore, over the next 10, 20, 30 years, we have to assume, I think it's prudent to assume that borrowing capacity isn't going to change very much, unlike it did, again, in past history. Therefore, we can't necessarily rely on past growth rates to say, oh, look, this area has done really well over the last 20 or 30 years. Let's invest there. It might have benefited from, and it probably had benefited from, an increase or rise in borrowing capacity, and that stimulus won't be there probably for the next period of time. So therefore, we want to invest in a location that attracts people that can afford to pay more, whether that's people receiving inheritances, help from family members, people that are in business, people that are earning higher than average incomes. Obviously, education is often very aligned to earning capacity, so people that are higher educated. And so that's what you really want to think about in terms of making a very long-term decision, which property in fact is. You want to think about those locations. So if the problem therefore is if you move too far out, you're not necessarily, most of the buyers there are going to be limited by borrowing capacity, and their borrowing capacity is very closely linked to their income. So if their income isn't rising substantially, they won't be able to afford to pay more for the same asset. Whereas if you move to a blue chip area, that's not quite true. That the linking to incomes and borrowing capacity isn't as stark. There's other financial benefits, which I've written about before, that the owners in that area will be able to enjoy, that helps them afford to pay more for property in that location. The other factor that would invite me not to go too far out in terms of too far away from the CBD is the fact that you want to leverage the laws of supply and demand. And we've got to realise that there's growing pressure on state governments and councils to really increase the density in our capital cities, particularly in the locations that are close by the city, because obviously that's really well serviced by amenities and public transport and these sorts of things. And so I think there's going to be growing pressure for them to do things like simplified development application processes, introduce more flexible planning rules, and those sort of similar measures. If that happens, and when that happens more correctly, that'll make that blue chip location even more valuable, because there's alternate uses to that land. When we've got really strict planning regulations, then if all you can do is own one dwelling on that property, then it's only got one use. Whereas if you have more flexible planning opportunities, the alternate uses start to become more valuable for that particular parcel of land. And so it's going to be very difficult for our capital cities to continue just to spread out because, of course, then you've got to build infrastructure, which, of course, is costly and timely. A simpler solution is to increase that density, and there's been a lot more talk over the last 5 years about that occurring. Notwithstanding, if you buy in an outer location, of course, you're buying closer to an area where vacant land is in abundant supply, and of course, that doesn't then play towards those supply-demand dynamics that are then going to have an impact on future prices and future price increases. So that's why I would be inclined to, not want to compromise in terms of the locality of the asset, buying something, buying an area that's, that's closer to the city, because I think that there's going to be, greater use of those properties in the coming years. Now, I thought it'd be useful to look at a bit of a case study. Let's assume that we've got a budget of, say, $700,000 to $800,000. Let's look at some specific ideas of where we could spend that money. And of course, because I'm based in Melbourne, I've got better knowledge of that market. And so let's talk about Melbourne. So if I wanted to buy an apartment in Melbourne for that budget, 700,000 to 800,000, I'd buy in East Melbourne. And the reason East Melbourne, it's so close to the CBD, so has so much amenity. It's got limited development potential, which will, I think, put a cap on supply. There's very active community opposition to development in East Melbourne. We can debate whether that's worthwhile, but it is what it is, and you're just not going to. That's not going to change. It's been like that for many years. There's something called the East Melbourne Property Group, and they will just agitate any developer that wants to develop in that area. And within that budget, you could buy a 1 to 2 bedroom apartment in an older style block. It'll be in a nice, quiet street. It'll be probably a really well maintained block with great aspect. Really comfortable property to rent out or live in. Now, if I wanted to buy a house in Melbourne for 700 to 800, I reached out to a buyer's agent that I respect tremendously by the name of Kate Bakos, and asked her for a couple of possibilities. Where would I spend that budget? And she said, well, one option could be to purchase in an outer suburb like Laylaw. So for those who don't know where Laylaw is, it's about 30 k's from Melbourne CBD. I don't really know where it is either. And the investment thesis behind that would be that Laylaw is benefiting from gentrification over the coming years, and that will continue. And so that would be the investment thesis behind that. Or alternatively, you could buy in a really great location in a regional town such as Ballarat. So you could buy like a period property in maybe one of the best streets in Ballarat. They're the two kind of housing options. And out of those two options, if it was my money, I'd go for Ballarat because I think quality trumps everything else every day of the week. And I would rather have a really high quality asset in Ballarat than a pretty average quality asset in Melbourne. 30 k's out from the CBD, it's way too close to, abundance of land supply. And whilst it might be considered a middle ring suburb because it's only 30 k's out, it really is in a unique position where it is only 5 k's away from just really vacant land and bushland. So I think I'd go for for that reason. I would go for the Ballarat option. So therefore, it's really a comparison between, do I buy an apartment in East Melbourne or do I buy a house in Ballarat? And my conclusion would be, if you have a long-term time horizon, say more than 10 years, I would buy the apartment in East Melbourne, primarily due because I expect mean reversion in that market. Whereas regional markets have had a boom during COVID. Okay, some of that's come off a little bit, but they're still relatively high. I think you could argue that their value at fair value doesn't really represent good value. Whereas I think Melbourne apartments are cheap. They're cheap by historical standards. They're cheap compared to what properties will cost. A decent family home in East Melbourne's north of $4 million. So apartments to get into that location is a very affordable way to do that. And I think you'll benefit over the next 10 years from the fact that apartments have been stagnant in Melbourne for the last 13. Now, I'm not convinced that that would change over the next 5 years. So if you don't have that long time horizon, maybe I wouldn't go apartments. But I certainly think there's a very high probability of that changing over the next 10 years. Anyway, a bit of a longer episode today, so I apologise for that. But hopefully that gives you a bit of insight to some of the things that you want to think about when you're contemplating, that if your budget doesn't extend to an investment grade house and you're contemplating, do I stick in the investment grade location, get an apartment, or do I go outside of that and buy a house? There's no one size fits all, and I think a really trustworthy and credible and experienced buyer's agent can help you tremendously with making these decisions, to helping you sort of weigh up the options in your geographical market for your particular budget. Okay, I hope you enjoyed today's episode, and if you did, please share the podcast. Please leave a rating on the platform that you listen to. It will help me tremendously, and until next week, bye for now.